Good morning, everybody. My name is Brian Wagner. I am the Chief Architect of Prodigio RTS. Prodigio is the robotic trading system offered exclusively by TD Ameritrade and thinkorswim. It is a fully functional trading platform that integrates directly into your thinkorswim trading account, and there's been a lot of exciting things that have been happening lately. There's been complete integration between the TD accounts and the thinkorswim accounts. And so somebody can correct me if I'm wrong, but I believe Prodigio is now available to the TD accounts in 100% working capacity, as it was for the for the thinkorswim account holders. You get Prodigio by requesting Prodigio activation. You can request Prodigio activation by sending an email into support@thinkorswim.com with the subject line Prodigio activation, include your username and your account number, and they'll get you set right up with a button on the thinkorswim trading platform. You press that button, it launches the platform, and the accounts are fully integrated. So right here I've got just a paper money trading account right here. This has a bunch of positions on. These positions are tied in directly with my thinkorswim trading account. So all of the activity on the one shows up on the other, etc., etc. It all clears against the same account. And what's so exciting about Prodigio is that there's a lot of really nifty tools, and it is the foundation for a lot of the newer tools that we're building. And these tools allow you to gain access to a whole new range of scanning functionality and robotic and automated trading functionality. We'll mention some of the things that we're working on towards the end of the chat, but we're really excited about a lot of the scanning functionality that we're building on the back end. Prodigio, we have our goals at being no less than the best scanning system out on the market, so I'll talk a little bit about that later on. Follow us on the web, twitter.com/wizardlab, and we host these chats every week, every Wednesday at 11 o'clock Central, 12 o'clock Central, and they're always archived on the web, prodigiorts.net, under the video archive. Today's chat, we're going to talk about oscillators. Now, oscillators are an interesting topic, and the reason is because there's a lot of them. There's a lot of oscillators, and a lot of them measure more or less similar things. The most important thing that you could possibly know about oscillators is what they're actually trying to do, and to know kind of the differences between them, or what ones are subtle variants of one another. And so there's a lot of information available on the web. The Shadow Trader guys, they incorporate oscillators into their own technical analysis. They do a lot of sophisticated analysis, and that's only a part of it. But as a trader, if you understand even just the basics of how these oscillators work, you can give yourself an edge in your trading. And that doesn't matter if you're a day trader, it doesn't matter if you're a swing trader, or even a position holder. They kind of let you see when optimal entry points present themselves to you. And this shows up right inside of the chart. Now I'm going to generalize here for a minute. And you have to be careful with generalizations because they're not true all of the time, but I've got an interesting oscillator down here called RMI. Now RMI stands for the Relative Momentum Indicator. And this is kind of a variation on RSI. And I want to show you the general behavior of this oscillator. Oscillators are generally a technical analysis study. It's driven by math formula. And this math formula is processing the price points on a chart. So here it's kind of scrunched up at the top here, but I've got a price chart on Apple, and you can see the OHLC candlesticks of the price movement. Right now it's trading at around 383.31, 37. It's ticking around there. And an oscillator runs a mathematical formula on that price data, and this is what makes it an oscillator. Now, they always show up usually on the bottom of a chart. Sometimes you can mix and match them and you can overlay them, etc. But the thing that makes it an oscillator is that it modifies the range. As traders, it's very important that we're looking at charts. Right? And so, especially if you're a day trader, you probably have at least 2 monitors, and on one of the monitors you probably have at least 4 charts looking at different things, and probably more. And some of these guys really have some sweet setups where they've got multi-monitors and etc., etc. You can break things out in Prodigio, by the way, using the advanced layout. But what makes an oscillator is that it takes this range value. charts have a domain and a range, right? And so I'm going to get a little high school algebra on you for a second here, right? A chart has a domain and a range, right? It's got an X and a Y. It's got a right to left and a down to up, right? Because you're making a graph, right? You're just drawing a line, and the values mean something. And as technical traders, or even as fundamental traders, these values are very important because they mean the difference between making money and losing money. Well, the range is simply what you see on the right-hand side here. And whenever I'm looking at a price chart, my range is always the price, right? And we truncate this, right? So we truncate this range over here on Apple. It starts at 370 and it goes up to 390. Now, I could feasibly make a chart where I scroll this all the way up, and what I'm doing is, see this price down here, 212, right? I'm getting closer to 0, right? And then I can kind of get it very close to 0. See, I'm close here. The range of my price chart, it now goes from 0.48 all the way up to 383, right? And what's that doing? That's actually scrunching all the price values because they belong way up there. It's at $380, right? So these prices down here, $100, that's meaningless on this chart. Right? Well, what I'm doing here is I'm manipulating the range. And that's important because the range is all about oscillators. Now I'm going to have to zoom this back so I can fix this range here. You can always hit this reset down here, by the way. It kind of resets the zoom. An oscillator performs a calculation and it changes the range, usually to something that's meaningful or valuable to you. So, for example, everybody knows RSI. If you are entering into the world of technical analysis for the first time, one of the most fundamental oscillators is something called RSI. And I have that up here, and let me actually scrunch this down. I'm looking at RSI right now. RSI stands for the Relative Strength Index. And this is kind of one of your fundamental oscillators. It was developed by Wells Wilder when he first started doing his technical analysis back in the 70s. And it was one of his main indicators that he used in order to find pivotal moments in price action on stocks that he and his firm were trading. So the RSI, what's meaningful about it, now just to give you a description, it's measuring the differences in up movements to down movements. So in other words, it's going to look back over the last 10 periods. So this has a period value of 10, RSI 10. That means it's always looking forward in time, and it's always going to consider the last 10 bars that just happened. Right? So right now it's always looking at the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars. It's looking at these bars. And it's actually going to count the movement between those bars. It's going to look for green bar, red bar, and the degree to which those bars are green or red. So if I zoom in, not all bars are created equal. Some of them are bigger, some of them are smaller. And that price action matters. It matters because that's where your profits and losses come from. That's where your market is made. He's taking a very simple concept. He's adding up the ratios of all these up moves versus the down moves. So he's extracting the bullish movements from the bearish movements. He's separating them, and he's creating a ratio. And so that ratio is basically like who wins. Who wins in this situation? Well, what happens when you have more red bars than green bars is the bears start to win. Right? And when you have more green bars than red bars, the bulls start to win. And that's just very basic common sense. He's taking that out, he's rehashing that, making a ratio, and he's showing you the winners of the bulls versus the bears using a relative calculation. That's why it's relative strength. And he's plotting this on a chart. And because it's a ratio, ratios are very important because that's what you need to get a percentage value. Everybody understands percentages. If something is half done, it's 50% done. If it's all the way done, if it's get or done, it's 100% done, right? Well, that's all this RSI is. It takes those values. It does this intelligence for you by separating the winners from the bulls from the bears. It's relatively massaging those because the size of the bar matters. And it's translating this into a percentage value so it's easy to consume. right? And that's what really makes an oscillator an oscillator. It's this whole range. A lot of oscillators will use percentages as their range, right? Because it's very easy for us as people and as traders who have to make very fast decisions to just look at a percentage and generalize what's going on. So, I mean, I can make a generalization on the price action on Apple. I'm looking at 5-minute bars, right? And it's around lunchtime, and things tend to consolidate at lunch. This price action, it's relatively flat. I mean, it's still moving, but relatively speaking, it's not taking off in either direction. It's just kind of going sideways during this period over the last half hour or so. That manifests itself in the RSI because the value right now is 50%. And the RSI is basically saying, well, there's no bias in the direction of people buying or people selling. There's no overbought or oversold condition. It's right in the middle right now. And RSI measures that bias, which we call overbought or oversold. And after studying, say, this technical analysis indicator for years, you know, people, and I believe Wilder kind of made this generalization as well. And it's a rule of thumb generalization that if the RSI value is greater than 70%, you're in a period where the bulls are winning. And he considers that an overbought condition because market has opposing forces, and in a market, the bulls can't win forever. Otherwise, there's not going to be people on the other side who are just going to want to feed money to them. You know, and that's what makes a market a market. You have this continuing change in direction of supply and demand, and you have people who need something now or they need something later, and everything goes around in a circle, and it creates something that you know, hopefully is sustainable. And I'm not an economist, but the markets are very interesting to say the least. I think we all agree on that. But this percentage, it's like a rule of thumb, and you go by it. You don't have to hold it as critical, right? See, here's a point where the RSI, it was close to 70%, 69%, right? Well, that's pretty close. And if I'm looking at that, I might make a decision. I might say, well, it's kind of overbought in this situation. And if I take that as a consideration, what happened in this very brief time period, and you have to keep in mind, I'm looking at a very short time frame. What happened was there was an upswing in price movement, and it did continue to go up. Now, I mean, this trend could have continued, right? There's going to be bigger market forces that would have caused this to, say, consolidate, or intrinsic forces, etc. You know, all of these things that happen naturally in a market. But what you can notice is that this high point right here on AAPL, and this might be the high of the day. No, it dipped actually. This is the high point when I'm looking at it from, say, 1030 on. This high point is actually the high point on the RSI. Now I see a value over there, 69%, and this might be the 68%, right? So this is actually the highest RSI on my chart that I'm looking at right now. I'm not saying that it predicts the future. However, it manifests itself in the oscillators. And this is the key to today's conversation. The behavior of price action and volume action and anything else that you can measure. When studied under technical analysis, what technical analysis gives you is perspective, so that the things that happen naturally in the movement of the stock manifest themselves in the oscillators. They will not predict the future. However, if you're looking for a specific trading criterion, such as an entry point, if you want to short AAPL and you start looking for an opportunity at 1030, well, I can see two pretty good opportunities. This peak right here at 11 o'clock, where the RSI was at 66%, and this opportunity here at 11:15, which was 69%. And if you took either of these price points as opportunities to go short, and especially if you're going to hold a swing position, you could do a lot worse. You could do a lot worse, especially if I zoom in. And let me actually just drag these out. Sure makes a lot more sense to be short at these price ranges than to be short at the low of this range. Right? And And I'm not saying in any case that you made a good or a bad decision, but if your decision in this case is to go short, you want to give yourself every advantage, every edge, every opportunity that the perspective of technical analysis oscillators can give to you. Right? So I'm talking really from a mathematical standpoint, because I am a mathematician by education, and mathematics it can't really. It's a tool, is what it is. It's not a crystal ball that predicts the future, and nothing ever is. However, using a little bit of common sense, you can use mathematics as a tool and become an amazing trader. Those guys at Shadow Trader, they do a fantastic job. And they can't see the future, obviously, but they're using their perspective, they're using the information that's given to them, and they're making decisions. Here is one tool based on math that you can use, and hopefully today you have the tools that you can use to automate this in Prodigio using Wizard Lab. But it would have been, relatively decent to get short at this local maxima. When I talk about charts, especially if you're into math, you talk about maxima and minima, right? Well, what the heck is that? That's peaks and valleys, right? These things slope, right? There's a valley. When it dips down, that's a valley. Here's a peak. It's a mountain peak. That's all it is. Well, the mathematical term for that is a minima and a maxima. These oscillators, and I'm going to get into the detail, right, of how you actually use at least these oscillators. There's a lot of them, but I'm going to focus on these today: the RSI, the CCI, and then back to the RMI. They can really give you an edge because they're a tool. They're based on mathematics, and they let you see things that are difficult to see. What Wilder was doing, it's really hard to see because he's actually pulling these green bars out from the red bars. That's hard to do. I mean, you can do it. You can look at a chart and you can say, okay, well, I got 8 red bars and 3 or maybe 4 green bars, right? So, okay, maybe this is more, towards the bottom of these oscillators, right? I'm going to be talking about CCI, and right now you see CCI. It's at the bottom of its domain. I'm sorry, its range. Its range is a little different. It's close to a percentage, but it lets it tweak above and below 100% and below negative 100%. So actually, I got a question here. I do try to glance at the chat while I'm doing this. I try, but I have a lot of material I want to cover. How do you handle the RSI of trending stocks, which can remain overbought/oversold for an extended amount of time? Actually, that's a good question. What Sis is getting at here is that these oscillators, right? And I'm going to talk a little bit about this. Sometimes they can peg, right? So I've got I was talking about RSI. Let me actually zoom out and see if I can find a period where this is happening. Actually, I should probably look at a bigger range here, 60-minute. And actually, this is a pretty good example. This is a pretty good example. Not perfect. Let me drop volume because it's kind of getting in my way here. Take a look at these charts really quick. I've got price action looking at 60-minute bars during the day. I'm going to cover RMI in detail, by the way. RMI stands for the Relative Momentum Indicator. Price action had been declining on Apple, right, over the past, say, couple days or so. Now it just got a huge upswing, but it had been declining. And notice what happens here on the RSI. It crosses back down below 30% on its range. So that means, according to Wilder, it's generally oversold, right? And you should be looking for opportunities to have a reversal. Well, what happens is the price movement continues to go down, and RSI kind of pegs in this oversold condition, right? So RSI, it pegs, especially if there's a breakout or a breakdown in either direction. The best possible way you can identify when these pegs happen is by combining oscillators with trend and direction indicators. And I'll probably allude to some of that later on in the day, but we've done chats in the past where we've talked about how to measure market direction, how to measure trend in a stock. And with some of the scans that we'll be working on, some things such as patterns in the future and things when you have channels and you have support and resistance, et cetera, et cetera. Things that you can do with linear regression. If you combine your oscillators with the trend or direction moving items, you can create logic using Wizard Lab. Wizard Lab is the component of Prodigio that lets you create trading automation. And you can combine these together to make a system that is the sum of its parts. And so you're doing something intelligent, which is, I know I'm in a downtrend. I know that, say, the RSI is coming out of a oversold condition, and I know I have a price trigger. Right? If I look at this chart, I can see that I have a general downslope, and then what happens is RSI had been below 30. All of a sudden, look at this bar, the 60-minute bar. There's a huge upswing on AAPL. The RSI breaks back above its 30 range, and if I were to put, say, a moving average on here, which would be a trigger, I could put, say, an exponential moving average, right? And I can tighten this up, right? Because I like to use, when I use averages, I like to keep them short. And the reason I like to keep them short is so that they kind of mimic the price movement a little bit better. But of course, that's depending on your trading strategy. But I could put another one up here, and I can offset this one. If I say 3, well, I better make it 2 periods. And make this a little thicker. And what happens is this bar actually causes a trigger if I look at some forms of moving averages in here, right? So, I mean, I have the offset, and this yellow line crosses above the white line, right? So I could create a system where when I have such a rush inside of that amount of time, it creates a trigger, right? So now I've got a system that has trend. It has the oscillators to analyze the general momentum of a stock and to find momentum swings. I could add a trigger, and finally, if I wanted to, I could add confirmation. Now, I'm going to be showing you how to apply this to trade optics, which gives you a cue that puts all of your signals in the same place. That lets you be the final judge in the system. When I get signals in, I'm running a couple of very basic strategies. If I load, say, a target here, this shows me where the signal happens, and I can confirm this signal visually using ChartTrader Pro, so that I can always include my own knowledge and my own expertise and my own judgment as a final step. So getting back to how these oscillators work, I'm going to talk about CCI, and then I'm going to show you how to build this in Wizard Lab so that you can start creating strategies that use oscillators. CCI is a really interesting oscillator. And I know Woody has a famous formula for CCI. I don't remember if we have this yet or not, but if we have the permission, it'll be in here at some point. I'm not sure about that. But he's an example of a guy who knows this stuff through and through, right? He does some pretty cool things actually. But CCI, at least the idea of a CCI, is something that he considers very important, and it is very important. CCI stands for Commodity Channel Index, and what this does is this is also measuring kind of up to down movements. Right, and the idea behind the CCI is it's really comparing the price action intrinsically versus an average. So the formula is a little more sophisticated, say, even than an RSI. RSI is very basic. It's just, if you look at the study for RSI, all that does is add a couple things up and create these ratios, and it applies a little bit of smoothing. Right? It's very intelligent, and like I was saying, it allows you to see things beyond what you can see by just glancing at a chart. But the idea behind CCI is, if I were to to rank them, I'd say it's slightly more sophisticated. It is also measuring overbought and oversold conditions. And so the general idea is you look for mean reversions, or you look for reversals when you get a CCI. And look at this price action back on Apple. CCI if I compare, I'm looking at a 14-period CCI. This is actually a 2-period smoothing. Right? So this red line, it's nothing more than a 2-period average. Right? And a 2-period average is easy. It's take the current value, take the last value, add them together, divided by 2. And that's the average. It gives you a basis for comparison. And the CCI can act as an oscillator that attempts to pinpoint reversals. Right? So this is very interesting because it's a little bit more effective than the RSI, which tends to peg. But as I hope to explain to you today, you can combine the two together. Right? And I'm actually going to combine them together with the RMI. But CCI, Commodity Channel Index, look at where the CCI value crosses. Right? So the chart, it says there's a CCI value and there's a signal line. Signal line is usually something that you're comparing against, and you're looking for a signal. You're looking for a cross. And what happens is the price movement was going down, and you have a very significant bullish bar right here at 1040. This is very significant, and that manifests itself in the oscillator value of the CCI. If I look at this chart, now it was in fact below this green line, and by the way, the range for the CCI, it generally goes from positive 100 to negative 100. And you can consider this a percent. However, the values can kind of exceed 100%, and they can exceed negative 100%. 100% is obviously a bullish situation, and negative 100 is a bearish situation. So what was happening in the CCI is we were generally bearish, and I'm going to come back to this point. See, I'm close to negative 100. When I make my rules, I only use that as a rule of thumb, and I kind of take some liberty in these threshold values. I don't use 100 and negative 100. I use things like 95, right, or 90, or even 85. It's really just rules of thumb, because when I combine oscillators together, it's kind of like looking at the same picture from multiple perspectives. Right now, I think art is very interesting, and I am definitely not an art buff, right? But I think that if you are an artist, you could appreciate looking at a piece of art from different perspectives, right? So in other words, you look at a picture, right, and you look at it up close, right, and you see just a bunch of dots. But then if you look at it from the other side of the room, you see a landscape with people, you know, whatever. Your perspective matters a lot. And so if you use multiple perspectives, you can start to harness what's actually going on with the price action. Right? So CCI, if I look at a cross over the signal line, I can use that as a trigger. And I can say that, okay, I've got a relative reversal. And I can use that as a tool for whatever I'm trying to do. And in this case, it works out really well. Now, again, you have to be careful when generalizing strategies, right? Because you've got to use multiple perspective. This is where Wizard Lab excels, actually. Because especially if you have never seen Wizard Lab before, Wizard Lab lets you create rules by dragging and dropping things together, and you kind of connect them. You really just connect the dots, and that builds your system for you. And what's so nice about it is that you can use logical operators, right, such as an and I can keep joining things together, right? And I can create a system that looks at 4 or 5 different things, and I don't have to fuss with all the coding that would go along with creating scripts to do this. One thing that's very difficult to do is to tie scripts together. That's very, very hard. And even if you use scripts, a lot of people will use a script, you know, say a think script, and they'll import it into their trading platform. Right? And that's really cool because you can kind of take advantage of someone's hard work, you know, which they're kind enough and willing to share. But if you try to combine these things together, and let's say you have 10 think scripts, and you want to blend them together, that's pretty hard to do. That's actually really hard to do. I would look at that as work, actually. And I'm a professional software developer. You know, it's hard, and it can be done, and sometimes it's worth it. But the nice thing about Wizard Lab is you can just drag and drop these things together. And if I have another rule, you know, I can just drag out a rule that I had built previously, and now I'm looking at 2 different things. But getting back to the oscillators themselves, this CCI, it's kind of picking reversals. It's not going to be perfect all the time. That's why we have these thresholds of 100 and negative 100. It will be more accurate if you're closer to those thresholds. And there's a very basic reasoning why that would be true. The reasoning is that the price movement, it can't continue in the same direction indefinitely. Well, I mean, generally speaking, you can have a fundamental bullish or bearish movement on a security, right? I mean, if a company is growing and booming, the price is going to move up because it's becoming more and more valuable. On the converse, if a stock is crashing, it's just going to keep going down, because the value is being lost. And that's usually driven by economics. But if you're trading, and so like if you're trading, and if you know that a stock is just crushing it, it's killing it, it's everybody's investing in this thing, it's the wave of the future, and it's just a great investment. There's always going to be people taking profits. There's always going to be people taking the other side of the trade for various reasons. One of the things that someone taught me a long time ago is that time has value to it. There's a monetary value for time, right? That's why we have interest. That's why there's inflation. I mean, I wouldn't keep money in this is a bad example, actually. I wouldn't keep money, okay, here we go. I wouldn't purchase a bond, right, unless I knew that I was going to make money over time. Right? It's pointless to buy a bond unless there's some interest in it for me. Right? So there's a value to your time. And people are constantly trading, seeking for different styles of profits, because sometimes it's worth it to them to liquidate the position. Right? So they might have already made a lot of money, and they might want to move that somewhere else. So in that case, they become, for a long position, the seller, and you, as someone looking for an opportunity, finds the other side of that trade. Well, there's always these oscillations because nobody does the same thing all the time, and that's what these studies can measure. So this is finding the inflection points, and it's built using a heuristic that looks for general patterns in the behavior, right? So it's looking for an upswing, and I define that, 14-period upswing. Find me something that's reasonably close to a reversal after a large upswing. Now notice in the middle of the channel with an oscillator, it can get confused a lot, right? And this actually does a pretty good job, I'd say. It does the cross over on this period, so like it dips down and then it crosses back above, and then it dips back down below again. It actually does a pretty good job if I just look at these reversals, because it considers this a cross up and it considers this a cross down. So it's pretty good. But this middle range is usually reserved to filter out kind of the uncertainty. Kind of like the garbage signals. It's probably not worth your time to trade CCI signals that are around the zero line, because it's probably a little bit too confused. But CCI, we're going to use this as something that picks optimal entry points. And CCI is a great example of this, and I'm going to show you how you can use this with RMI. So, CCI, if I want to make a Wizard Lab rule in Wizard Lab, I go to the Wizard Lab tab. Now here's my canvas that I was talking about before. And again, we're talking about strategy here, so a lot of you guys joining me today, you've seen a lot of this, and you've seen me work with a lot of this before, and you've built your own strategies. You've built a lot of your own rules before. I'm going to start with a clean slate. I'm going to hit new. But I'm still going to walk through the steps, again, because, well, to get some new people into the system, but also there's always something more to learn. There's always another little trick or technique or whatever, in everything. So I'm going to try to hopefully augment your knowledge today. So down here under the technical analysis study, and this is something we have coming along the pipe. So we're working on kind of like a new and improved classification system for several things. This is kind of coming along the pipe. It's kind of a side project. We'll be able to kind of group these things together. But here's a CCI. Right, and I just pulled, all I did was I dragged my mouse cursor, and you see it follows my cursor, the icon, and I just drop it in, and I've got a CCI study. Well, this CCI, it has a parameter, which is the number of periods. Right? Now that, if I look at the chart, that's for this orange line. Right? That's the default. I can always change the color of these lines. Let's make this very bright and thick. This bright thick yellow line is my CCI line, and that's the raw formula in and of itself. Now, a lot of times when you put studies on a chart, they come along with additional studies. And they're actually additional. The study itself is CCI. If you go to the the books, or you look this up on the web, you'll get a formula for CCI. And that formula applies to this yellow line right here. But in order to make systems and make triggers and signals and things that are relevant to trading, they're usually complemented with an auxiliary study. In this case, it's a 2-period simple moving average. We're going to build this system in Wizard Lab, but I wanted to show you that the CCI can be demonstrated by looking at the primary study. So I've got my primary study here, right? And that's CCI 14. And the way that the rule builder works is that you're actually defining code for the system to use. Under the hood, when I connect these things together, it's actually making a series of logical connections. It's creating statements in a language which is under the hood. Now, it's a very basic language, and it would actually be a language that would be difficult to program with, but it was designed to make it visually oriented. So in other words, this language that it's based on, it has everything connected to one another. It makes it very easy to connect things together, to pull them apart, to rearrange and reorganize. That's something that's not necessarily the easiest thing to do in scripts or programming code. So this kind of lets that, makes it easy for you to do. The logic is driven by data. And what you're literally doing is you're telling the system that as data comes into the system, as these OHLC candlesticks come in, what should I do with it? And the way that you define that is by connecting things together. You're literally pointing the data flow in the right direction. So we call those output into input. And when I connect the OHLC output, and I can drop down to 5-minute bars so that I match my chart. When I drag this output into this input, I am literally pointing the 5-minute data into a CCI study. And what's going to come out on the other side are the CCI values that I get on the chart. So this yellow line is now coming out of this CCI study, and I can tell the system what I want it to do with it. Well, I want to create a system that gives me signals in this case. So I'm going to go to my logical operators. And logical operators are really the thing that makes your system a system. They define how things should be evaluated. And that's actually kind of a technical description. When I use the word evaluation, that is exactly what the system is doing. But let's say I want to get, well, today is, well, it's consolidating. It had an up move. Let's say I want bullish signals today. I'm going to be optimistic. And let's see here. Things are generally up, so I'm going to look for that kind of burst of afternoon trading activity that happens. And I'm going to want for the CCI line to cross above that red line that I was seeing on the chart. Right? I actually want this line to cross above this red line. Right? And I can actually change the signal line. I can make that thicker as well. Right? So I've got the thick yellow line crossing above this thick red line. So what I have to do is I have to say, well, all right, now where do I get the red line from? Cross above needs 2 inputs. It needs input A to cross above input B. Oh, in this language, by the way, it's different than ThinkScript, right? So anything that you've got in ThinkScript, you want to rebuild by working in the Prodigio Wizard Lab. There's a series of templates, and there's a series of pre-built studies to get you started. It's kind of easy, actually, to set these things up. It's pretty easy to put these things together. But there's a lot of things that come out of the box, and we actually just went through and we had one of our guys kind of doctor some of these up to make them a little bit more helpful. There's a lot of templates. We're going to kind of trim these down so that they're the most relevant templates, etc. But when I want to define that cross above signal, I have to think, well, this red line, right? Where do I get this red line from? All that is it is the 14-period CCI smoothed by 2 bars. Right? So I can go here, and I can actually drag this out and copy. I can right-click and I can copy, and I can paste. And what I'm doing here is I'm creating a second CCI study, which actually, under the hood, when this calculates it, it's really pointing to the same one. But my definition is a second definition because I'm pointing this in another direction. And that direction is to do a 2-period simple moving average. And SMA is a study that you use all the time. It's an average. I mean, averages are a great heuristic. I don't care what you're doing. I mean, averages are just useful. And they're useful in trading. They're useful when you're building a shed. They're useful when you're, baking a cake. Anything you can think of. They're useful in your fantasy football league. Averages are just darn useful. This is how you do an average. You use the SMA study. Right? I can pull this output and send it into input B of the cross above. And that will trigger signals. This cross above study, this is going to fire signals only when, and the description up here, when I look at these studies, I get a description. It'll state this. It only gives me a signal when things cross. Now what happened now, which was interesting, now on the forming bar, this bar hasn't finished, it's still forming, it's still got 3 minutes to go. It had crossed below that red line, right? And if it stays there, now that might end up above it, it hasn't closed yet. If it stays there, then that yellow line will be below the red line, and it might cross back above, right? If that happens, I get a signal. Now, if that happened, that wouldn't be that good of a signal because I'm kind of in the middle of the channel. So I'm going to show you how to build that into it as well, right? So this is going to give me the cross signal. But, like I was talking about the range before with these studies, you also want to consider the location of the technical analysis value with respect to its range. I mean, I cannot stress how important it is that what makes an oscillator is its range. So I can say, I want to filter this a little bit. I don't just want signals in the middle of this pattern, or in the middle of this, this oscillator, right? I want signals that have a lot of meaning behind them. And the degree of how much meaning I want is going to depend on whatever thresholds I'm looking at on my range. Right? If I look back in time, this cross had a lot of meaning. And it had a lot of meaning because there was a significant downward movement, significant downward slope, and that movement did reverse direction. And this reversal had a lot of meaning because there was a significant upward movement, and that did change direction. Now, I might get a cross above here, but I didn't have a very significant downward movement. And the reason why you have to take these things into consideration is because this study, as an oscillator, it measures the degree to which the rebound is going to happen, but that's only based on the contingency that there's enough direct motion to warrant the rebound. Right? So I mean, just because this thing crosses, it doesn't mean anything's actually happening. This study takes as a very basic tenet of its own philosophy that if something extends in one direction, you are more likely to reverse in the opposite direction. And if something is consolidating sideways, you are already at your mean, and it doesn't make any sense about mean reversion. Mean reversion doesn't mean anything because you're already at your mean. Right? So it's important that you take the range into consideration, and I'm going to show you, as I alluded to before, how you can apply these kind of fuzzy boundaries to this oscillator. Right? So I'm going to say that because negative 100 is my generally bearish or oversold threshold, I'm going to use negative 85. And that's actually going to open up the signals for me. Now I can tweak this however I want. If I want it looser, I can open it up, and by opening it up, I can do that by making this negative 85. If I want it tighter, I can go a bit past 100 to be 105. But that's all going to depend on how many other conditions you have in your rule. Right now in WizardLab, it's very simple to do that. Because I'm adding a condition, I go to my logical operators and I drag out an AND study. Right? And what that does, let me double click here to give me some more real estate. This AND will allow me to evaluate more than one thing at the same time. And what I want to do is I want to make sure that this CCI value, I can copy this again, is below a certain threshold. Over here I can use my less than operator. And if I use a constant value of -85, that's going to filter out my signals so they only trigger when the CCI value is below -85. -85 can be represented by pulling out constant from the source data. And I can just click here, I could spin it, or I could hit -85 and hit enter. And I've got a filter. Simple as that. And I'll collapse this right after I finish it. To end a rule, you end this in a trade action. A trade action really just says that this is the end of the rule and now the system should fire a signal. You can chain signals together because when I save this, and let me collapse this. So there's my rule in its entirety, right? And I can say save as, and I'll give this a name. I'll call this CCI signal, right? Because that's going to give me a signal when the CCI crosses. It's actually a bullish signal. I'm just going to call it CCI signal for now. And when I save that, that rule shows up in my rules. And I will have CCI signal, and I'll be able to chain these rules together. Now, I won't go into detail about this, but the way that you set all of this up, say for back testing and deployment, you just build a strategy, right? And I just take my CCI that I built, a CCI signal, I drag this from the scanning section into my rule. This side, buy or sell, that's going to define whether or not I want to see bullish signals or bearish signals, and it's very important for backtesting and robotic trading. And I can always add some management, closed position rules, etc. Under the management section here, there's a whole bunch of things that you can do. You can reuse any rule that you make, or you can just drop some, say, a trailing stop order. Right. So here's a trailing stop order. It executes at GTC, good till cancel. And I can have an offset, and I can say, all right, well, put it at about a 0.5% down. And I have a very small resolution here, but if I collapse this, I can see all the fields here. 0.5% down. That's like on a $50 stock. That's going to trail my stop starting at 49.76. I can save this. I can save this as CCI signal strategy. Right? And of course, you can run this in backtest. Right? I'm going to do a raw mode backtest over a week on the S&P 100, and that'll run. That goes up to the server that just finds all the signals. And again, what this is doing, this is a part of a strategy running in raw mode. I'm looking at the quality of my signals, and I do this a lot. Right? So on the first run, I don't look at the P&L, right? Because I'm not just going to be able to make a random strategy and have it be profitable. Right? I'm going to look at something. I'm going to find out where it traded it at, and I'm going to look at the quality of my signal. And I'm going to look at this, right? And the CCI, as this crosses over it, that's in the ballpark. That's not bad. So this is doing what I'm asking it to do. I just have to create a system that ties everything together. That's a pretty decent signal. If I were going to go long, and if I went long here, I could have been a lot worse, right? I could have gone long here. Even if I went long right here at 1320 on 830, that's a big difference between going long at that high, which is 46.05, versus going long at, now it went long here, right? So let's say I take that open, 45.87. The difference between 45.87 and 46.05 is significant. It covers your commissions. It already puts you in the profit zone. You're ready at this point to take off, and look at what happens on this one. Now, again, this is just a raw mode example of the signal firing according to the definition of the Wizard Lab rule. And that's always your first step. You want to validate that you created a rule that does what you expect it to do. That puts you in prime position to take these profits. Now this was trailing it at a tight 0.5% stop. So what happened was price went up and it put the stop up here and it got out. But you can see that clearly this was a fantastic time to go in, as long as I knew some other things, such as the general momentum was changing, and I can look at broad market indicators, etc. When you create these rules, you want to start by deploying them to trade optics, and you deploy a strategy to trade optics. So I just saved CCI signal, and that'll be at the bottom here. I'm going to deploy this against the S&P 100, and I can just check it off, and that sends it up to the server and starts scanning. So every 5 minutes I'm going to get a new scan, the result of a new scan, and it's going to populate this queue with any signals that it gets for that CCI reversal. And so here I can create a system, and a strategy is like a system. I mean, a strategy is really synonymous with a system, where these tie together, and I can bring in as many components as I want. Right? So for example, if I wanted to expand on this CCI signal rule, I can hit New, and I can use CCI signal with another study that I had built, and I'm just going to pick one at random and join these together into a bigger system. Right? So I'm just combining these things together with an AND. That's it. I'm saying I want CCI signal and I want this DMI cross, which isn't relevant for this conversation. RTS and trade optics. The difference between the two is that trade optics gives you your scans in real time, and when you get the results, they'll populate. These signals come in. You can sort these, in any way you want. I'm control clicking here. Usually it's sorted descending by time. But when I click these, trade optics will show me where the signal happens on the chart, and RTS trading is the really exciting part of it when you create the system, which is just killing it. It's just making the right decisions all the time. You can deploy in RTS strategies, and that will cause the system to begin robotic trading. It will auto-trade your signals. It'll use the entry and the management rules that you specify in the strategy builder, and it will automatically trade your positions according to your risk parameters, which are available here under settings. And so it's really cool because you can create a system that trades all day long, and the possibilities of this are really limitless. But again, I encourage you to start small, learn the system, develop a system and a trading strategy that works for you, and then when you're ready, you can deploy it right in for robotic trading, and that completely removes the element of human error in the trading. So it's a pretty brilliant system. You also got some macro functions too. I've got a lot of positions open here, so I can close these three all at the same time. And again, this is tied in directly with your Thinkorswim account. So those trades, it's very easy to trade rapidly on this system. That's our whole goal, rapid trading. You make money when you can get in and out just like that, because you can pick your entry points, and that's what this topic's all about. So the last thing I want to do is I want to show you how you can expand on this and tie them together. Right? So I had begun the chat today by talking about relative strength index, RSI. RMI is relative momentum index. This is an extremely interesting oscillator, and I want to go back to AAPL. Actually, I want you to see these two by themselves for a moment. RSI and RMI. Now, I've got RSI at 10 periods, and I've got RMI at 10 periods. RMI has some additional parameters. The first parameter is the most important one. That's actually your momentum periods. If I click on RMI, and I can just click Studies here, and I can just scroll down to RMI, or I can begin typing in the filter up there. And if I select this, it'll apply a new study, a new oscillator study on the bottom of my chart. The first thing you should notice about RMI is it looks a heck of a lot like the RSI. Right? And another thing that you should notice is that the percentage range goes, again, from 0% to 100%, just like the RSI. And 30% and 70% are, once again, significant thresholds on the RMI, just as it is for the RSI. But the RMI does something a little more clever, and it adds some more weighting inside of the formula. It's, again, measuring up movements to down movements, but it's reflecting in on itself these ratios in a way that's slightly modified from the RSI. Now you can look up the formula, but what this amounts to is it amounts to a smoothing of the RSI with very low lag, because the lag is not, when you apply a moving average onto any kind of technical analysis study, it always applies something called a lag. And we call it lag because, again, this is all about perspective. Things manifest within the data. So if you're averaging the data, and if the data starts shooting off in one direction, the average has to catch up because it's still got all of those old prices inside of it. Right? So we call that lag. It's the degree to which something has to react to the changes in the underlying instrument, like a price action. The RMI is manipulating this lag because it's not just applying a simple moving average, which is very basic. See, if I do a simple moving average, or even an exponential moving average, it's still got, for 10 periods, 9 periods of old news. 9 periods of old news. But sometimes you can manipulate the math so that you're not looking at that old news as much, or you're looking at the new information in a different way. That's what the RSI does, and that's what RMI capitalizes on. So it's a really cool variation of RSI, and I can use this to measure overbought and oversold conditions. Actually, somebody from the Prodigio chat turned me on to this indicator a long time ago, when we first started doing some of these. Actually, it might have even been before the chats, but all of this information, it comes from people who are really using these instruments and really trading them. So I've had the privilege to work with some of these guys in the past. This RMI it's kind of like, I would consider it a super RSI. That said, you can apply the same techniques that I just applied on the CCI to the RMI, right? And now I could, right, and I want to demonstrate this, I could add an extra indicator. I could add a simple moving average of 2 periods, right? And then I'm going to say, okay, thick line, and oh, it's nice and dotted. Well, let's make it look like the one above it. And I'm actually going to change the color of my original RMI indicator. I'm using the RMI, and now I've got something that looks a heck of a lot like this CCI. Now, you notice these two indicators, they have tendencies and they have patterns that tend to mimic one another. That's because the movement of these oscillators is nothing more than a reflection of what's happening with the price action. And RMI, although measuring something different, what happens manifests itself in the data. And so I could create a system using RMI, doing the same thing as the CCI, right, by going over to Wizard Lab, and watch what I could do. Watch how easy this is. I could go to Open, or I could go to my CCI signal, right-click and hit Open. Right? And here's my original CCI, and if I want to change the CCI to the RMI, see here I've got CCI, here I've got RMI, and if I want to make the same system, just change the study, all I need to do is go into Wizard Lab, go down into my technical analysis, find RMI, right? So that's down here in RMI, and I just need to replace it. Right, so we were looking at 14 periods, right? So let's do 14. And again, there's a momentum. There's an RSI momentum periods. That's the second parameter. And let's see, this is doing 10 and 3. Let me change this to 14 and 3. Right, looks pretty much the same. They're still different. They're similar but different. And all I need to do is to cut that out and drop it in place. Right, I can copy it. Right, I can paste it. I can cut out the CCI, I can put that in place. I can do it one more time over here. And I want to think a little bit because, remember, the range is different for RMI. And let's say, and I was talking about kind of using general thresholds, why don't we use 35? Right, and see what I did But these two probably wouldn't work well together. And does anyone know the reason why? Oh, sorry about that, lost sound for a second. It's that simple to just to put these together. Right? So I looped back around. Yeah, I noticed you guys are saying the sound isn't coming in. So I'm going to give this just a moment, That's okay, I'm not moving. Let's see here. Sound back? All right, good. Okay, so I caught that. I didn't move. It's that simple to build a system that you just kind of chain these things together. But the point that I was making was that these two signals, right, they probably wouldn't work good together. Right? And the reason is because they're both triggers. I mentioned this before. When you build a system, I like to think of it in terms of a series of triggers and filters. And these two, yeah, I'm going back over like maybe about a minute or two. I really didn't move on too much since I replaced the RMI. Right? But I'm just making a point that these two studies probably wouldn't work well together. The reason is because if I look at a chart, see, these are two triggers. I like to break the system down in terms of triggers and filters. A trigger is something that uses a cross study, basically. And so, this CCI study, it's going to give me a trigger here, and this RMI trigger, it's going to happen, a little bit later. They're not going to happen simultaneously. I mean, they might, but that's going to be very rare. So I can use these two as triggers, but if I want to combine these two unique perspectives of what's happening on the stock, the way that I can do that is I can create a system that uses triggers and filters. Right? So I call these signal. Right? I'll keep signal as my main. Signal means trigger, basically. Let me open up really quick the RMI and show you how I would combine these together. So instead of using, say, a cross above, I quite simply would want to just trim this down a little bit. And why don't I use the one down there, actually? Right? I'm not going to need an AND for this one. Right? I'm going to go to the right and bring this back. And so let's apply a little bit of common sense reasoning. If these oscillators are generally measuring overbought and oversold conditions, right? And if I'm going to use the RMI as a filter, right? Let me actually remove this. I'm going to use the RMI as a filter for my CCI. So I'm going to say I want CCI triggers, and I want it to be in range, but I also want the RMI to give me a filter for confirmation. Well, as a filter, right, this should be a little bit more loose than I would use it normally, because if it's too tight, it's going to block too many signals. So I'm going to use RMI, I'm going to use its thresholds, and I'm going to be very loose about it. Right? So normally, say 70% is a good threshold. Well, I'm going to go all the way down to 60%. I'm going to say, and where does 60% happen? It's actually, I can draw it. See, I like to draw these on here, and I like to configure them. I'm just right-clicking and things like that. It's pretty intuitive. If I put it at 60%, right, I can make it thick and dotted. Right, I can make this green. Actually, let's make it dashed. It's a little better. So I actually just put a line at 60%. I'm going to use the RMI as a filter, and I'm only going to accept the signal. Actually, you know what? I'm looking for the bearish ones. I want the RMI to be below 40%. So actually, let me move this. Let me move this down by configuring this. You see what I was doing? Did anybody catch me there? The signal that I had built looks for the bullish signals, and I got a lot of them in my backtest. It looks for a reversal back up. If I want confirmation by the RMI, I want to make sure the RMI is below a threshold, but I want it to be relatively loose. Right? So I might want to pick 40%, or I might want to bump this up to even 50%. Depends on the nature of the results that I'm getting. So to use the RMI as a filter in conjunction with the CCI as a trigger, I can make this rule, which is make sure the RMI is less than or below 40. And I can go into my Wizard Lab and I can bump this up to 40. And this rule right here, I can save this as RMI filter. And I can create a new system that uses RMI filter with CCI signal. Put an AND in between them, connect them together, and then I can call this something to the effect of CCI RMI system. When we do software development, so here's a good thing. 60% is bearish, must go below 50% for a bullish filter. I want to change that. I actually like that. Let's see. Okay, I forgot an end actually. I actually want to make this a little bit looser. So let me go back to the RMI filter. Yeah, I forgot to connect this. I'm actually going to bump this up to 50. Just for illustrative purposes, and the more you understand that even if I'm making a mistake, you can just tweak these things and see how the results go. But now I've got a system, right? CCI RSI system, or RMI system, sorry. And I can use this in a strategy, right? So let me just drop this here. Let me add in CCI RMI. Save that as CCI RMI system. Right? And I run that back test, and I'll get a different set of results, which is based off of a system that combines one trigger and one filter. And this is how you can kind of combine oscillators together by studying them, by studying the technical analysis, studying the charts. Hopefully I've given you kind of like a brief introduction into some of the ones that are pretty cool. I really like that RSI indicator. That one's pretty cool. And you just look at the range of the oscillators, and you can combine them in Prodigio and in the Wizard Lab Rule Builder as just a series of triggers and filters. You can create a system. You can specify the parameters of that system, run a backtest. Now this is running right now, but when I'm ready, I can deploy the system right to Trade Optics, and I can drop this down of my pre-built design scans. It was kind of a bullish scan, right? So I just select my symbol list, deploy that CCI RMI system, and the system is now scanning for those signals. Right, so I've got a lot of like little signals coming into the queue right now, actually. So here's my backtest results, and I can look at something positive, right? Actually, let's look at one of the positive signals. Where it didn't predict the perfect entry point, but boy, you could do a lot worse than going long here. I mean, look at the dip, right? If I went long at $66.90, the lowest price point, the low here, was 66 and 69, right? So I believe that was at 21 cents. Was that 90? That was 20. I'm sorry, that was the high. Yeah, 21 cent. Dip before it reversed, and I caught this movement. So especially now, remember I have this trailing stop, which is way tight. If you pick this entry point, you can catch this move going all the way up, and this is just a rudimentary system of oscillators. I'm not even taking trend or market direction into consideration in this example, and you can start to see the kinds of things that you can put together by just combining things using the simple logic of a Wizard Lab rule. And so that said, that's everything that I want to cover for today. And I hope that I've kind of given you some insight into maybe some of the way that this math stuff works. Some people are a lot more technical than others, and you don't need to be like a math genius to figure all this stuff out. As long as you know that these tools are there, generally what they're trying to look at, it kind of gives you perspective. It lets you see things at different angles, and just combining these different angles together gives you more leverage in what you can do with what you know and what you feel in your heart as a swing trader, day trader, or position trader. And so with that said, I'm going to wrap up today's chat. I'll publish these rules and strategies right on the web, on the blog, prodigiorts.net. Follow us on Twitter, twitter.com/wizardlab. It always gives me a special feeling when I see the number of subscribers go up. It's always a really cool thing. But we host these chats every Wednesday at 11 o'clock Central, 12 o'clock Eastern. Send in any questions to prodigio@thinkorswim.com. We're always here in the chat, so you can always come into the chat, ask questions, get help with strategies, and we have a pretty big forum on prodigioRTS.net that you can always post questions to and get involved with the Wizard Lab community. So as always, thank you for joining me today, and I hope to see everyone here next week for our next Prodigio Wizard Lab chat. Thanks, everyone. Have a great trading week. Enjoy the start of the football season. Root for your team, and I wish everyone great trading and the best of luck. Take care, everyone, and see you next week.